Hey, Roger, what should I be doing now to set myself up to rock retirement within the next 5 years? I get that question all the time, so I decided to make a free guide to give you actions you can take to set yourself up to rock retirement. And you can check it out at doretirementright.com. Do you want to have the confidence to truly rock retirement? Well, I'm going to show you how on the Retirement Answer Man Show. Happy Thanksgiving, my friend. My name is Roger Whitney. I am your host. Excited you're here today. We have a few bits of news and then some questions on a variety of topics as we explore your questions here in November. So the first bit of news is in January, we will be doing our next edition of Retirement Plan Live. For those of you that are maybe a little bit newer to the show, you can go back to January of this year in 2021, where we did a case study with Trish. Trish was let go from her longtime employer. She was there like 25 plus years unexpectedly, and this had to do with COVID. And it really threw a wrench in her retirement plan. And so in Retirement Plan Live, you can listen to Trish and I talking through where she and her partner are at, what their retirement goals are, what resources they have to fund them. And then we culminate the month-long series with a live webinar where the subject, in this case, Trish back in January, is on live with us while we walk through some of the high-level analysis of whether they can actually retire, whether Trish had to get a new job in that case. So you can check that out in February because we do this with a listener. And so we're taking applications now for listeners that would like to be the subject of January's Retirement Plan Live case study. Now, a couple of things if you're thinking you might want to. Number one is we have dozens and dozens of people apply, so we can only choose one. Two, we'll work and change your name and change some of the details. And we're very sensitive to trying to keep it anonymous, but still get the story out for everybody listening to the show. And over the last 7.5 years, these have been one of the most popular episodes. So if you are interested in submitting your name to be the subject for this case study, this retirement case study, 6-Shot Saturday, this coming Saturday, and then the Saturday after that, we'll have a link to a little form that you can complete. They'll ask your name and a little bit about yourself, etc., so we can compile the candidates, and then we'll reach out individually to choose one. This time, there is no theme. We typically have had themes, people with pensions, no pensions, people who live very frugally, women only, etc. This is just going to be a grab bag. We're just going to look for somebody that would resonate. So if you're not signed up for 6-Shot Saturday and you want to be considered, you can go to rogerwhitney.com, and somewhere on that first page, there's a sign up for 6-Shot Saturday, which is our weekly summary email. So that's the first bit of news. Second bit of news is 2022 is just around the corner, and we're working on our themes for the year. Let me give you an idea of some of the themes that we have. We have, obviously, Retirement Plan Live. We're going to do a month-long theme on leaving a legacy. How do you pass assets on efficiently to family? Retirement for business owners, people that have a business that they have to navigate selling or unwinding, etc. We're going to have a month-long theme on overcoming frugality. The idea that we're so used to saving, we get into retirement, it's hard to loosen up the purse strings a little bit, even if it's for things that we actually care about. We're going to do a series, and we're not quite sure what we're going to call it yet, but planning for 2 and then 1. So if you're married, how do you plan for the transition to one person? Because a lot of things change, tax limits and etc. We're going to do a month-long series on where to live in retirement. So this is we're going to explore moving to a different state. We're going to explore places, more organized retirement communities like the Villages, and there are many others just like it. In fact, we may visit one, FYI. And we have a number of other themes that we're thinking of. So it's going to be an exciting year in 2022. Last little bit of news is that Medicare is increasing for 2022. They just came out with the increase to Part B of Medicare, which is the part that you pay for. This covers doctor's visits, outpatient services, etc. So it's going to go from $148.50 per month per person to $170.10 per month per person. So that goes from about $1,782 a year to just over $2,550 a year. That's a 15% increase. Now that's a lot, right? In 2021, the increase was about 3%, and I'm looking at the last 10 years or so. But back in 2014 and 2015, they had 0% increases. So this can vary widely. We saw a 16% increase in 2016. 19, we saw a 1% increase. So you can see that this is an expense that continues to just chip away at the retirement equation. So I wanted to let you know about that announcement. We're so thankful we have healthcare in retirement, aren't we? Even though we got to pay for it. Now let's go to some listener questions. Our first question comes from Don on QLACs.
Hi, Roger. This is Don from Locust Valley, New York. I've been listening to your podcast regarding saving on taxes this month. You and Andy are doing a great job. I was just wondering if you ever consider using QLACs when you are retirement planning in order to reduce RMDs. I guess you'll explain all that to your listeners. Thank you so much for your show. It's wonderful.
Well, thanks for the question, Don. So Don is talking about QLAC, which stands for Qualified Longevity Annuity Contract. So this is essentially a deferred income annuity or a longevity annuity. So those aren't really new concepts. So a deferred income annuity, if you put in $1, you can delay when you annuitize or turn on the monthly payments that are guaranteed by that dollar. And then in a future date, say 10, 15 years from now, when you turn on the monthly payments, those payments are guaranteed for the rest of your life, or if you do joint life, guaranteed for the rest of you and your spouse's life. That's a deferred income annuity. A QLAC is a special designation for certain deferred income annuities. So what happened is, as securing income with annuities has become more prevalent in retirement planning, you had some issues when you were dealing with pre-tax money. So if you had money in an IRA and you put it into an annuity, well, when you hit now 72, you would have required minimum distribution. So how do you handle the required minimum distributions if you have this money in an annuity? It made it a little bit difficult to use deferred income annuities within IRAs and 401ks, et cetera. So in 2014, the IRS approved purchasing using pre-tax dollars and made provisions for how you deal with RMDs. So this is essentially how it works. A QLAC is really just a deferred income annuity that's funded from an IRA that has a special designation. So it has to be funded from a retirement account. In exchange for $1, you get guaranteed monthly income that you can start sometime in the future. In order to have the QLAC designation, it has to start at no later than age 85. You can't use a variable annuity or an indexed annuity. The payout options for something that's considered a QLAC would be life only or life with a cash refund of some sort. And the limit of the amount that you can do with a QLAC designation for an individual is $135,000 or 25% of your pre-tax or IRA dollars, whichever one is higher. So you can only put the max of up to $135,000 into a QLAC. And if you do that when you reach age 72 and you have to do your required minimum distributions, when you're making that RMD calculation, you will totally disregard the monies that are in this deferred income annuity, designated as a QLAC, when calculating your RMDs, so that money can continue to accrue and grow for a later annuitization in life. So that's essentially how they work. So Don, you want to know, are these something that you might consider? Well, I think yes. I think they definitely can be something you should consider, just like you might consider purchasing a deferred income annuity as part of your overall distribution plan. So I wouldn't start with a QLAC because that's very tactical. I would start with building your plan of record and identifying your preferences for how you want to fund it. And if you want to have secure income sources above and beyond any pensions or Social Security that you have, then you likely would look at a immediate annuity or a deferred income annuity. And if you're looking at a deferred income annuity to help secure some of that cash flow for later in life, then you would want to consider doing it as a QLAC so you can help a little bit with required minimum distributions if you are going to be using IRA money. So that's definitely not a bad strategy. It's a little difficult because on an individual level, you can only do $135,000 as an individual. And if you are looking to purchase something in excess of that, that can be difficult. But I think it's definitely something you should consider. But I would think through it in the way or the sequence that I just described. You want to be to the point where you are really looking at purchasing a deferred income annuity in the first place. And if that's the case, then you can go down the QLAC decision tree to see if that can be part or all of that for you. Hopefully that helps. Now, our next question is from Rita. Rita says, for 2022, would you consider looking at long-term care again? I know you did a series not that long ago, but it seems like things are continuing to change and there are some stats in dispute. Maybe just a catch-up episode about what has changed since the last time you reviewed the topic. Thanks so much. This is my favorite financial podcast. Well, that is awesome. Thank you, Rita. Yeah, we did a month-long series on it, I believe in February of 2000, if I recall. And we did an update, like a one-episode update on the state of long-term care insurance early this year. I know we had Steve Kane, the subject matter expert that we used and we brought him into the club, I know. So yes, Rita, we will do, if not a month-long series, a mini refresh on current stats about long-term care in terms of usage, probability of having to use, and then take a fresh look at some of the products available to help transfer some of that risk. So yeah, look for that in 2022. Now, Steve has a question on decumulation.
Hi, Roger. My name is Steve. I'm going to be turning 65 in January of 2022, both me and my wife. And for the most part, historically, I've been more of a moderate to aggressive growth type investor. And now that we're actually retiring, I'm looking towards, definitely becoming more conservative. I'm looking at, trying to get the most bang for my buck. For instance, BDCs, business development corporations, REITs, preferred stocks, etc. And I'm really, going back and forth trying to decide, which I should get. Should I get a mix? And also in regards to the risk involved, I want growth, somewhat growth, but more importantly, a higher dividend rate. Can you possibly help me with this? I'd appreciate it very much. Thanks so much.
Hey, Stevens, thanks so much for the question. So Steve is turning 65, and he wants to, quote unquote, get the most bang from my buck. And he mentioned BDCs, which are business development corporations, which are just a special structure of investments, real estate investment trusts, REITs, which invest in all types of real estate and are required to throw off the income from those real estate assets, preferred stocks, which are this whole weird beast of itself. A preferred stock, the modern version of a preferred stock, isn't like your grandma's version of a preferred stock. A preferred stock back in grandma's day was literally a preferred share class where you were due the profits from the company before it went down to common holder dividends. That's how, we generally think of a preferred stock. And what happened was, I think this was in the 90s. I remember when this was all going on. Now what happens is companies will open up a separate corporation, issue bonds to that corporation, say XYZ company preferred whatever, and they'd issue bonds to that company. And those bonds would provide the income to the quote unquote preferred stock. So you don't see the traditional kind of preferred stock near as much as you used to. And he wants to know which ones he should get now that he is 65 and getting ready to retire. And I think this is really reasonable to think about, Steve. And what I would caution you at is thinking in this one-dimensional way from, I'm retired, I need to pivot a little bit from aggressive growth or moderate growth, as you mentioned, to something that throws off income because you're retired. You may not need the income. It may not be a big part of your retirement decumulation strategy. I don't know. But I think that is the normal way that we think about it is, okay, now that I'm retired, I just need to go buy more things that throw off income. And as you mentioned, you want the most bang for your buck and you sound like you still want growth. So I think it was last episode. It's really important, I think, Steve, as you approach this, that you don't approach it from the bottom up. I'm 65 and about to retire. I need things that will throw off income. That's coming from the bottom up. And I don't think you're going to get to the best solution for you from that approach. I think what you need to do is start with get a feasible plan of this is what basically build a huge cash flow model, which is essentially what a retirement plan is. This is the spending that I see myself and my wife needing over year 1, year 2, year 3, year 4, year 5 at least, and then out until you pass. And the spending that you're going to need are going to be divided into 3 categories. They're going to be divided in your base needs to live a life, something that you don't want to compromise on. That can include the country club. It could not. But whatever that need category is that you're not willing to compromise, then the next layer is going to be those discretionary things that on a year-by-year basis, depending on how the world is going or life is going, you cannot spend. And then lastly, the aspirational things. You want to understand, especially at the beginning of retirement, at least what the first 5 to 8 years are of that. And then you want to have your long-term projections. Then you can compare it to all your resources and know statistically, is this feasible given all the resources that I have? Right, Steve? And that will give you a good sense. And maybe you've already gotten to that sense. And then you go to phase 2, which is, okay, now that I know this is feasible, how do I make it resilient? How am I going to actually provide those dollars for each of those years that I'm going to need the money so I can live my life? You got to make it resilient. Now, income thrown off from preferred stocks or even common stocks, REITs or BDCs, as you mentioned, that could help provide some of the income to defray all those liabilities of your spending, for sure. But they don't necessarily have to. It is my belief that, especially at the beginning of retirement, you want to have at least the first 5 years of your spending totally covered, meaning zero risk in the sense of volatility. You want to prepay your spending for at least the first 5 years. And that's going to do a couple things for you. That's going to, one, de-risk it so you don't have to worry about markets going up and down in the first 1, 2, 3, or 4 or 5 years. Markets go down in the first year, you've already pre-funded the next 5. You have plenty of time. And that's going to give you, 2, a lot of psychological comfort, right? In a pretty difficult time when you're leaving work as you know it and going through this big life change. And 3, it's going to give you a lot of flexibility or optionality to respond to changes in the world, but also respond to changes in your plan once you're actually retired. Because when you retire, it's a weird thing. You're making all these plans thinking about a future self that you've never actually been. It's very common, Steve, to change your mind after you're a year or 2 into it. So having this cushion, and we call it an income floor, it's the first or layer or so of the pie cake. You got to do this first before you think of, do I buy BDCs, REITs, preferreds, etc. Now let's get to that part of it. You said you're aggressive to moderately aggressive in your portfolio, and you want to get the most bang for your buck in investing now that you're retired. I think it's important you define what do you mean by the bang for your buck? Are we talking about optimizing the possibility of more money or optimizing so you can have high level of confidence of your spending regardless of what happens in markets? Those are solving for two very different things. So more bang for your buck implies to me, you mean you want to hold on to as much potential growth as you can get while quote unquote investing for income. I think this transition, by the way, is one of the biggest transitions that I think is under discussed and underappreciated. Is you have built this muscle over the last 4 or 5 decades of embracing volatility, diversifying the portfolio, contributing money to it, reinvesting all the dividends and all the interest in capital gains, and then just letting time do its thing over decades. This is how you invest before you get to retirement, right? Well, now, Steve, you're here at retirement. That model doesn't work because now you have these lifestyle liabilities that used to be funded by your income year by year that are going to have to be funded by your assets or Social Security, et cetera. Now, dividends can be a part of this and sometimes a large part of this, assuming you have ample assets. So I think it's very reasonable to lean towards things that have steady cash flows. Now, I'm sort of focusing on the ones that you've mentioned, dividends and income from REITs. So REITs are, like we said, you buy into a portfolio of real estate. Sometimes it can be very diversified. Sometimes it can be focused on shopping malls or long-term self-storage, et cetera. And you own a portion of that portfolio and you have the right to the income that portfolio throws off year by year. And over time, in theory, you should have a growing income source. It should have some inflation hedge to it because if inflation goes up, rents go up and that gets passed along and goes to the people that own the real estate, which gets distributed to you. You could also throw master limited partnerships in there, although they're a little quirky, right? Things that own pipelines and energy storage things. Those have been horrible lately over the last 10 years, really. But I think this definitely should be part of your focus. I would also throw in there, other than preferred stocks, Steve, is consider leaning towards more quality common stocks that pay a good portion of their earnings out as dividends. I actually think that's a great spot to focus on. Now, not all companies have different philosophies around this, but if you can buy a portfolio of companies that have a long history of paying dividends and also have a very long history of increasing their dividends and respecting shareholders that way, I think that's an area where you could get a little bit of the best of both worlds. Because generally, when you're looking at companies that pay common dividends, there are a few types, right? But the ones you want to watch out for are ones that pay a lot of dividends, but they don't do it all the time. And it's at the expense of investing in their business, right? So you see their dividend payouts over time, if you look at history, go up and go down, and sometimes stop for a little bit and then go up and go down. Those aren't companies that are managing their balance sheets very well. But there's a subset of companies that pay dividends that have paid dividends year in and year out, year after year, decade after decade. In fact, there are another subset that have done that, but also consistently increase their dividends year after year after year. Now, if you're a company that does that, that means one, you have to have very good free cash flow and you have to be fairly conservative in how you run your business, because when you pay out a dividend and you say, hey, we're going to give everybody $1 a share this year, and that's what we're going to try to hit every single year, you've just obligated yourself to paying this kind of money out. So you better have the money there. So generally, they're good stewards of their balance sheet. And generally, they're going to be laggards in these kinds of markets because one reason is if they're good stewards of their balance sheet, they're probably not using tons and tons of leverage to go chase every growth opportunity. So generally, in really, really good up markets, they lag a little bit because they're enjoying the party, but they're not drunk with capital and growing like crazy weeds. They're more of the oaks of the forest. So I think that would be an area that you could lean towards. But I would say lean towards that area, maybe REITs, maybe BDCs, maybe MLPs, and maybe we do a series on what all those acronyms are. You want to focus there in your upside layer. So you want to have your contingency fund, and then you're going to want to have pre-funded your needs or your needs and wants, at least for the first 5 years. Then maybe in your upside portfolio, the rest of the assets that has at least a 5-year time frame, you can start to lean towards things that pay out income. I think that makes sense, but you got to go through it in the right order. Otherwise, you're just going to be focused on tactical things. Now, you asked about risks about a lot of these types of things. Well, one risk you're going to have with income producing assets are going to be interest rates, right? If interest rates go up, the value of assets that throw off income will go down because, at least in the short and midterm, because there's this repricing of assets relative to the new interest rate environment. Because we have these things called ratios, right? What is a REIT earn relative to what they call the risk-free rate of return, which would be the treasury? Well, if the treasury yield goes up, all of a sudden the yield of that real estate asset isn't as attractive as it was before. In order to make it attractive, generally prices would have to come down. And so there's always this readjustment. So one big risk when you have income producing assets is rising interest rates. And when you're looking at REITs or BDCs, MLPs as well, rising interest rates could have a double whammy, because it's not just the yield that gets repriced, is that these type of instruments generally use debt, meaning they borrow money to buy assets to make money and to throw off the income. And so if interest rates go up, the cost of borrowing money from them is going to go up as well. So you can have a double whammy from an interest rate standpoint. So volatility-wise, they can be much more stock-like than you would think. In the terms of preferred stocks that you mentioned, because of their structure, they're going to act much more like a bond than a stock. In fact, they're going to act like a very long-term bond, meaning that when interest rates go up, long-term bonds will feel the brunt of those interest rate increases, generally because the modern preferred stock is backed by bonds that mature 30 years out. So there's a lot of risk from an interest rate perspective. And what we're dealing with right now, which is really difficult, is, and I was having this question, I was in a little, they call it a mastermind, a study group with a bunch of advisors in Arizona between my COVID and my flu this month. And one of them, I'm like the old crusty guy now, right? They're all younger than I am. And one of them asked me, well, Roger, what do you notice any differences between now and the 90s? You know, the 90s, we had the great economy and amazing markets. And then he asked me, do you notice any differences between now and then? So I thought about it. And in the 90s, we had a very specific subset of the economy going bonkers. Technology, anything technology related, especially internet related. Value stocks, which generally pay dividends, did really poorly. REITs, real estate, didn't do that well. International, didn't do that well. It was very targeted in one sector of the economy that was creating these massive returns in the S&P 500. And so what I told him is, what feels different this time compared to then is that you really can't find any assets that aren't performing really well. Real estate, doing great. Stocks, doing great. Whether they pay dividends, whether they don't. Sure, the tech stocks are probably doing better than most, but everything is moving up. It's hard to find assets that haven't done well. And so here's the hard part, whether you're buying a stock that pays a dividend or you're buying real estate, if you buy something overvalued or at least highly valued, if interest rates go up or we see a turn in the cycles, those assets are going to get hurt. And if you buy something that is highly valued, meaning rich or overvalued, and you use leverage, like real estate and especially some of these closed-end funds, that's a whole nother conversation, in order to get yield. And so if you have something that's highly valued or rich or overvalued and you use leverage, if you go through a normal correction cycle, it's just going to be magnified. So I think it's really important, Stephen, that you take it in the right order, because it's not about getting the most for your buck in terms of potential return. When you leave work and you're retired, it's about securing outcomes and making sure the money's there when you need it, because that money is needed for your lifestyle. So you want to do that part first. And then the assets that you invest that maybe tilt towards income assets like REITs and dividend paying stocks, et cetera, will have a long enough time frame where you can ride the cycles and hopefully statistically come out with a much better experience without sacrificing your retirement. So that's how I would think through it. And we'll have more conversations in 22 on income producing assets. Our next question comes from Karen. It's sort of a long question, and I was trying to edit it, so I'll try to edit it as I go. Karen says she's been an active listener for about 2 months now. Well, welcome to the show, Karen. Excited you're here. Glad you're thinking seriously about retirement. Karen says she's planning to retire in 2022 at age 61. And I've been wanting to ask this question, but I don't know quite how to phrase it. So she outlines the situation. Essentially, what she wants to know is, how do I simplify my investment account and rebalance without triggering a big tax hit? Karen says she recently reviewed her investment portfolio and she has more than 50 different investments. So by that, she meant 50 different mutual funds, stocks, a few bonds, some outside investments. She says she's not very diversified. Well, she is very diversified, but about 70% of those 50 different investments are in equities. But she really wants to tidy up and consolidate them into as few of funds as possible. But I don't want to trigger a big tax gain, she says. She says she also has a deferred account in which she's able to move things around without paying capital gains, for sure. And she's rebalanced that to about 65-35. Plus, she has some other assets. And she's planning to do some Roth conversions between age 61 and age 70. But in this one after-tax account, she obviously has huge capital gains, and she has over 50 investments. Well, Karen, you're not alone. You're at this stage where you're trying to pivot from an accumulation-focused portfolio, and we've talked about that, to a decumulation portfolio that's supposed to serve you, sort of harvest what you've grown. And you're also not alone in having a lot of different investments. You have 50 different investments in one account. It makes, the first thing that came to mind when I read that, Karen, because this is overdue for me, it's on my to-do list, is my closet. I go in there and I just got stuff. I've just accumulated. Oh, yeah, I remember when I bought that. Yeah, I remember what I was thinking when I bought that. And that happens in investment accounts when you get to be 61. It just does. And if you do that and you have these amazing markets, they're going to grow. And then you get to this point and it's like, wait a second, I don't want this much risk. But what do I do tax-wise? So you're not alone there. So what do you do about that? Well, first off, I think you need to accept that there is no right answer for how to shift from accumulation to decumulation. You wish there was, but I think that's why it's even more important that you think about it in an organized way. So you can get to a point where you can make a judgment call. And that's essentially what you're doing in planning, right? Because it's so dynamic. So I need to ask you a question first, Karen. With this after-tax account, what are you trying to solve for? What are you trying to accomplish in this exercise in the first place? That's harder than you think to answer. It sounds like from the data that you've given that you have a feasible retirement plan, meaning that you have enough money most likely for your goals. So that means you're really in stage 2 of how do I make this resilient so you don't have the markets just throw up and all of a sudden your 70% of your account in after-tax assets goes down too much. I think that's the place to focus here, is on resilient. How do you make your plan resilient so you know you're going to have your life covered in the near midterm? I think that would be the place to focus, but you want to know what you're solving for. So what are some considerations on cleaning up? Now, obviously taxes, you mentioned that one. I'm a big fan for how Michael Kitces categorizes and talks about taxes, and that is you don't really avoid taxes. So we're not talking about avoiding taxes when we say, well, if I sold something, no, I might have a big tax hit. Well, if you don't sell it, and you're going to have to use the money at some point in time, unless you die with it, and you're going to have the tax hit then, right? So really, it's not about avoiding taxes. It's really the timing of taxes. And I think that's important because it changes the dynamic a little bit. You're going to pay the taxes. It's just a matter of when you decide to do it. And luckily, you're in a position where you get to make that choice. Just like you're making the choice in your Roth conversion strategy to pay taxes early so you don't have to do it again. Then obviously, you're going to want some ease of management, et cetera. So most likely, Karen, this is going to be a multi-year journey for you. And because of that, I think it's important that you don't get trapped in the game of inches. So the game of inches, what I refer to is if you focus in incremental ways in getting your portfolio to some undefined future state, you're just going to play around the edges. Whereas if you start at the beginning and create, okay, what would I do? How would I have all of these assets allocated if I didn't have any of these considerations? If I had my feasible plan and I said, okay, to make it resilient, I need these monies and these sequences, and these are the accounts that seem to make sense to get those monies from. And as a result of that, that means I need to have this much cash for year 1, 2, 3, 4, 5, and 6 of retirement in these accounts. So the money is ready and it's not at risk. And that is the process you would do to create your pie cake, which you may not be familiar with. You can go to rogerwhitney.com and we did a series on decumulation in July, August of this year. And that way you'll know I need to have X amount of money to pay for the next 5, 6 years. And I foresee that money coming from these accounts. Therefore, these accounts need to have this much in cash or cash-like or bonds or whatever. When you get to there, you create what should be without looking at the 50 positions in your account. Once you create what should be without being trapped in this game of inches, then you can look at what is, that's your 50 positions in that one account, plus your IRA and et cetera, and then start to map out how do you slowly reconcile the two? To what extent do you make them congruent? And then what is the incremental path to get there, right? You can do it quickly, you can do it slowly, you can do it a multi-year way. But I think if you build what should be for this new phase of life, Karen, and then look at what is, now you can have some form to start to map out that journey. So what are a couple little things that you can do? Well, one is in your after-tax account, stop reinvesting all of the dividends and capital gains from all these investments. Let that money come into the account as cash. So that'll at least stop the flow of money reinvesting to exacerbate the allocation that you don't want. So now you can just, rather than reinvest them, let all that money come as cash. That can help. And then start to plan very carefully for the great gap years, which you mentioned. You were talking about doing Roth conversions. The great gap years are going to be from age 61 in your case to age 70 when you start Social Security, right? Those are the years where you're going to have the least amount of income, so you can choose to do Roth conversions, or you can choose to start to harvest some of these gains, or maybe you do something in between. So it's going to take some multi-year tax planning to think through those. And you won't get it right. You won't get it right. That's okay. But that way you can see them together, because it may be you're focused on changing some of the 50 positions and starting to lower those and de-risk that account more. Maybe that's more important than Roth conversions. I don't know. But you have to have the framework to help you figure that out. Now, remember also, Karen, we have these great gap years from 61 and 70, but in terms of IRMA, which is the surcharge to Medicare premiums, those are going to have a 2-year look back in the income that you receive as to whether you're subject to those or not. And that's going to be at age 63. So really, you got 2 sweet years, 61 and 62, where you're not going to have an impact on IRMA, you're not going to have an impact on Social Security, et cetera. So those are the really great gap years. And when you're planning some of these transitional things, yes, you want to pay attention to tax brackets, but you also want to pay attention to batching as much as you can to minimize IRMA and other things. But I would start, Karen, with creating what should be absent the 50 positions that are all at high capital gains. It may be, and I've had the situation this year with a client where we chose to pay very significant capital gains because that, after going through the process, seeing that we still had a lot of growth on the table. We neutralized taxes in terms of we knew what we were going to pay. So we just chose to do it this year rather than future years. And it was really important to have the money available in order to fund their lifestyle. So it's okay to pay taxes. You just want to do it in an organized way so you can feel more comfortable about it anyway. Well, we've run a little bit long here. So next week, we're going to answer more of your listener questions. We're going to have Bill on annuities and lump sum, Michael on I-bonds. That will be very exciting, plus a few more. So with that, let's get to a smart sprint.
On your marks, get set.
And we're off to set a little baby step that we can take in the next 7 days to not just rock retirement, but rock life. Oh, you know, this guy has to be another thankful one, right? I was thinking about this the other day. Trying not to get sappy here. So we're about 7.5, almost 8 years into the show. Now, and I've talked about how the podcast has changed my life. It's really the people, you listeners, that have just warmed me in the sense that it's shown me how many proactive, intelligent, just super nice people there are in this world. I told you I was going to get a little sappy. I'm just blown away. And I've had days. I had one day, like I said, when I started the Rock Retirement Club 3 years ago, I talked to like 70 people in 2 days and to ask them questions about what would they want in a club like this. And I got those answers, but I was just blown away. I'm like, these people are so nice. They're so wonderful. They're so helpful. And at the rodeo roundup in late October, same thing. We had 100 people in a room and I'm like, it was like they were old friends and they had never met. That has blown me away. And I'm so thankful for that. So in the next 7 days, maybe tomorrow, go beyond the normal, what you're thankful for. You're thankful for your health. You're thankful for food and housing, your job, etc. Go beyond that and think about things that really warm your spirit that sometimes you sort of forget about because we don't want to, right? I hope you have a great Thanksgiving. One thing I'm going to be thankful for is that when we get Nicole Mills back on the show, she was going to be on this show, but scheduling, blah, 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 kids, Thanksgiving, etc., got in the way. So maybe next week. You be safe, all right? And rock retirement. Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.